Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Happy holidays, Jeff.
Happy holidays indeed. It's interesting to see halfway through the month of December, and this is the last full week of trading for 2019. So my question to you is, will we continue to see the markets move higher? It's been a phenomenal 2019.
You know, there's 5 key things, and 3 of them are out of the way. You have the trade talks with China, you have Brexit, you have USMCA, you have Fed uncertainty, and you have the election. 3 of those things seem to be out of the way.
I love the top 5. We may have to do that in 2020, Bob. But it's interesting to see the U.S.-China trade tariff conversation remains front and center. Will we see some type of momentum going into 2020 as now we have certainty?
Yeah, we have certainty there's not going to be any new tariffs, at least for now. That certainty can be short-lived, though.
All right, great stuff. Let's get this first lightning round. You ready?
I am ready.
Crude oil. Well, we talk about crude oil. It's interesting to see it's vaulted above $60. So what do we do with crude oil now as it's kind of at the high end of the range?
Well, talk about uncertainty. As you mentioned, we're at the high end of the range that we've been in since about May 19th. And volatility has gotten crushed a little bit. So what I'm looking at as an example is selling a risk reversal in crude oil. I'd be selling the 63 call and buying the 58 put. Right now, both legs are at about 18 ticks, so no cost on that.
So that's interesting. This is like a zero cost type of approach. And if you do see the market pull back a little bit here, would you potentially look at an upside call, maybe that 65 call in crude oil to buy that to define and actually have a call spread? So you're kind of legging into this approach.
Yeah, you'd be legging into the call spread. Those puts would kind of would creep up in value pretty quickly. So you kind of have the theoretical capital to buy those calls.
So we don't talk a lot about risk reversals, or we don't talk enough about them. We like to utilize them personally, but this is really an interesting and fascinating way to approach a potential range. Your thought process here that this is a range, and we're going to see the range persist for the next couple trading sessions, at least till the end of the month, because I know it's expiring on December 27th.
Yeah, again, the production cut by OPEC was announced quite a while ago, and we've only crept up to the top of the range, as I mentioned, that we've been in since mid-May. So there's a probability that it could pull back, not a guarantee though.
All right, fantastic. The Fed futures were utilized here, and they were trading about 60-70. The at-the-money volatility, which Bobby alluded to, was pretty low at 20.65, which certainly made that lower put, that 58 put, a little bit less expensive, Bob.
Yeah, also at the lower end of the vol range, with crude oil at the upper end of the recent range.
Fantastic. Let's remember, these are trade examples, not trade recommendations. Let's move into the second lightning round, pal.
Let's do it.
Financials leading. Well, for all you XLF traders out there who own specifically, if it's Citi, JP Morgan, all the banks, we've really seen the banks come back to life. Are the financials leading us higher here going into 2020?
Well, that's what a lot of analysts are calling for. We're actually seeing the 3-month, 10-year yield spread move up a little bit or steepen, so it could be a good call.
Well, as we've seen specifically that ETF, XLF move up about 30% year to date, I'm thinking the financials take a little bit of a breather here. So what I want to look at is the E-mini S&P 500, where a lot of those financials live. I want to be a seller of the end of the month call spread. It's expiring on 12/31, but the strikes I want to utilize, Bob, is 3250, 3300. So I'm selling the 3250 and I'm buying the 3300. The March futures are trading about 31.99, but this is a credit spread. We're trying to collect here, Bob.
Yeah, and again, the vol is low on this, but as you mentioned, that financial sector creeping up like this makes this a very good example.
And I think you also have to look at the strikes that I selected on this trade example, Bob. We're trading at 3,200. That was a price target of a lot of the big shops out there. Price target could actually be about 3,100. So here we are pretty extended. So all this is anticipating is that we're not going to see another 3 or 4% move higher in the market.
Right, almost at the money with that lower strike. As you mentioned, at the money vol was about 804 when we priced this. So again, it makes it a little bit rich in terms of the credit you might collect.
All right, Bob. Well, thanks, and happy holidays to you. Happy holidays to everyone, and thanks for tuning in to Striking Options. Please tune in every week as well as in 2020 as we continue to strike options.